This conference will now be recorded.
Hi everyone, it's Patrick Reed from the Adamus Principle. I left my boxing gloves away. Don't fret. For one, I'm not going to be doing any fighting with Beat. If it's anything to do with macro, I know who's going to be the winner. That is Beat. How are you, Beat?
Not too bad, not too bad. No, it's all social, it's all friendly. It's all
Yeah,
in the spirit of trying
exactly.
to
We
get.
we only want good disruptive dialogue on our shows and on our LinkedIn posts.
Uh,
So I was having an interesting week, and then all hell broke loose in my mind on Friday because we are Sherlock Holmes types, and both Beat and myself are always looking for the next narrative, or if we have a narrative and we love it, then the carpet gets taken out from underneath me. And it's like, hold on a minute, I have to rethink that. And then
Yeah.
you have to, you're playing the probabilities. You're thinking, okay, how does that fit in with all the other narratives, all the long-term narratives, or the short-term narratives and stuff like that? So the big topic for both of us right now is QT. And we've both been blogging and posting on each other's feeds about this. It's just really interesting. I'll tell you where I'm at and my thinking, and then if you'd be so kind to tell me just to galvanise what you've already posted on your feed on your thinking. So my current thoughts are interesting for me because I'm I'm a risk bear, and I kind of everything fits. All the stars are aligning. Europe's looking rubbish. The big thing that galvanized another star to align in my risk bear view was China PMI sub 50. That along with the change of monetary policy in that they're deleveraging. They're openly talking about, growth slowdown or it was 12% GDP forecast. Now it's around 6%. They've never really done this before. Okay. And I'm just thinking, okay, there's a change of tack there. They're deleveraging. They're so-called normalizing in their own way. So when the Apple news came out, when they had a miss on their phones, and that in itself was something, but when they cited reasons to China, that was something else for me. And then from then on, it's just been a case of right, Europe's rubbish, China slow down, and then obviously US exhaustion at the highs, city surprise index not going any higher, housing a problem, Australian housing a problem, but that's slightly different. So all of this together, you've got QT, you've got FCI, Chicago FCI at 50-year lows still, but the Goldman's FCI, bit of a bounce, bit of a big bounce actually. There are lots of concerns in the global slowdown, and I think I spoke briefly about this about a week ago, talking about is the US in recession. There are some indicators out there, which is led by housing, to say we could be definitely at a sharp slowdown. So, with all that in mind, I just want to do a little timeline I did on my feed, and the timeline I have is okay. My common sense will say we do not have a Fed put. Fine, that makes perfect, crystal clear, absolute common sense. But I always challenge myself, and I always say, well, sometimes maybe that was then, and it's changed, and maybe it shouldn't change. Maybe it's going to be carnage if it changes. Maybe they're idiots if they change it. Well, I've been around a little bit, and I've seen worse things. I've seen more idiotic things happen in monetary policy. So I just want to go through now a little timeline that I have in my head from, I think it was October, and it's not perfect, but it's a little time I had, and things started to change for me on the rate path and the tightening when Trump started to bash the Fed openly. At the time when I heard it, I thought it's not very presidential. I thought, bloody hell! I've seen him say some things on his tweet feed, but that's a bit, And then so there was the big thing about, is the Fed independent? Of course it is. Will it succumb to the Trump bashing? Of course they won't, right? So there's just that, and the market that was another thing I had to digest myself. The market had to digest it as well. The next thing, the comments from J Powell, way below neutral, right? Then there was the Clarida flip flop.
No.
Then it was just below neutral with regard to the rate hike. So I should have said that. Then it was patience, and then the big thing was data dependence. So we're now in a position where we have J Powell being pragmatic, which I think he definitely is, and anything can change, which is great. Which is, we're getting away from forward guidance, every meeting live, absolute hunky dory. The other two things that are on my radar from October, and let's face it, the US macro picture in October was largely pristine, was the OIS priced out a hike pretty much for this year. Eurodollar futures had this priced out before OIS. And the reason I'm emphasizing on that is in 2008, Eurodollar futures signaled disaster way before the curve, OIS curve. So it's just something to bear in mind. And now there are things being priced in on the OIS to suggest a cut creeping in this year, definitely next year. So that's another thing I'm bearing in mind. So the question I have, is there a Fed put? Well, it doesn't really matter if there is or there isn't. The market, let's just say it believes there's a Fed put, which is wrong, because I don't think there potentially is. If the market believes it, there is one. That's the thing. The other thing is, if we pause QT and the Fed is, some are saying that there was a J Powell pivot. Some say he's blinked already. If there is a definite pause on Wednesday or an indication, then you're going to get a growing chorus. Just say, oh, we thought that it was way improbable for the Fed to have regained on the put. So now maybe it's not so improbable. That's just something to bear in mind. The other thing I will say, this is going to kind of wrap up, and I'll hand it to you, B, is we've had just over around eight hikes. QT pause. All of this is common sense. Great. Let's just still rule out a put, right? All of this is great. So I'm thinking it doesn't matter if we got a Fed put or not. But if the data turns for the worst, then the Fed will act accordingly. And all I'm saying is, don't rule QT out on a pause. And what about QE again? Or what about verbalizing QE like a Draghi, whatever it takes type? And I can tell you now, if QE, if that's mentioned just on verbal intervention, I do not want to be short risk. So all of that together, you could actually say all of that is either pragmatic or a Fed put. The outcome's the same. And that's just all I need to say on that. So I'll hand it over to you, Pete. Thank you very
Okay,
much.
yeah, you've thrown a few curveballs in there. Let's try. I made some notes and try to kind of calm down. So reality is at first, the most important thing, and this is the work we do, is no matter what your view is, if there's news coming out that you think can change things, we have to accept it. You know, we can then start to talk about how high is it, what does it mean, blah, blah, blah. Reality is the story, and we don't even know yet if it's true. It was a Wall Street Journal story. We can argue no smoke without a fire. I would buy that. So all you need to know at that point is the moment you talk about pausing QT means stocks up, risk up, dollar down. That's really all you need to know on Friday. So if you know that, if you know what it means if the Fed would go on a pause in QT, you know the reactions, you definitely don't get caught on Friday. And if you flexible enough, which I'm not, you could even have bought risk, you could have sold dollars, whatever. So it's really important to know whether I'm a risk rally seller, whether I'm a euro dollar seller on rallies. Realities with the news on Friday, I have to take a step back. The step back doesn't mean like I accept the story or believe the story, or I think the story is going to have many legs. But what I have to do is at least give myself a chance to see the price action after the news. We're going to have, obviously, the China delegation is over in the US next week. So you, in theory, you could get a double whammy between some announcements around China and US trade deal. You could have a pause in QT, and you really have like all the ingredients you need for risk to rally quite dramatically. Now, for me, the view, and I come to that later, the view about 2019 will not change, and I come to that why. So that means I will observe how much risk does rally on all these announcements, and the moment I get the feeling that, you know, I would say if you tell me now we get a pause in QT, we get some form of announcement, positive announcement from the trade war, I would say, okay, the Dow has to go up 2,000 to 3,000 points over the space of whatever, you know, week, 2 weeks, 3 weeks. Now that is how I trade and how I take my risk. So I put an expectation to the news, right? So we have the news, so I have to be careful. Then I put an expectation to the news. So I go, okay, Aussie should trade up to 73.5 or higher. Euro yen should probably go 126, 127. So I just put numbers to actually the news if it were to come out the way we just talked about. And then I watch price action, compare the price action versus what I think it should do, and that is where my trade is. I start to realize that it's actually, now the rally is not that impressive, I might actually very quickly start to sell risk. If the moves are more ferocious than I expect, I might definitely take a step back and review all the sort of sell levels I had in mind in the start of the year. Now, coming to part two, and the view about QT, I personally still a big believer of it's a pragmatic Fed. It's not a Fed put, it's not a, but as you rightly say, at the end of the day, it doesn't matter what it is because we actually don't know until later whether what it was. We can't answer that question on Wednesday, even if they go for a pause. We don't know. Is it just pragmatic? Because realities, we just had the German government downgrade 2019 German growth from 1.8 to 1%, which I actually think is almost a bit stupid. I more believe the IFO that talks about 1.8 down to 1.5. The German government to go all the way to 1 sounds, you know, it's very severe. So if the government will be right, there's a big problem in Germany. And Germany is the biggest engine of Europe. So as you mentioned in your intro, Europe has its issues. Now, China's not going to be solved today or tomorrow. The trade war, you know, and I still think people overrate. That's why I had this sort of idea of selling risk soon, because this whole trade war story is just really running on its last leg. The trade war, yes, it had an impact. Yes, clearly there were few things that, you know, where people suffered or certain things that didn't go well, but it's not the problem why the stock market went down. this is not the reason. That's the second reason why I think, yes, we're going to have a risk rally in QT if we have a pause in QT. But the structural problems the world has of global growth has nothing to do with QT whatsoever. So whether the Fed, and that's my thinking, the way I start to, I can't say I know Powell, but I feel like I've done a bit of work on him and started to try to understand him. And the Fed, actually, to this point, is doing actually a brilliant job, in my opinion. So it's gone like full out hawk, everything is all right. Then data abroad started to really slow down, probably quicker than the Fed did anticipate. So he had to start to kind of, go on the brakes a little bit, at least in terms of what the hikes are concerned. And as you pointed out, the market pricing has been correct. So all the Fed has done, that's a very important point. The market pricing has been way ahead of the Fed anyway. So even if the Fed has lowered, the dot plot once, maybe they lower it again, maybe not now in January, but possibly maybe in the next meeting thereafter, they're only just catching up with what the market has been trading since Q4 of last year. So there's no move needed. So at the heart of it, and I just quickly had a look, the current level of the Dow is just 9% of the all-time high. Right? The low of the Dow when QE started was 6,500. We are now at 24,750, having topped at 27K, with 9% of the high of the all-time highs after an expansion of the last 10, 11 years that we've seen. I don't think the Fed is too worried about equities at all. And Powell's view is actually, even when we were at these levels, I think we were around these levels when he once sort of commented on a question where he actually hinted that things are valued a little bit high. So I think the Fed wouldn't mind a gradual, move lower in equities just to take some of this bubble territory out in order not to risk a real steep fall if things really start to go wrong, which could do if the data turns softer. Now, where I disagree with you, Patrick, is the word QE will not find its way into the vocabulary of the Fed anytime soon, right? Only if, and to the only if I come in a minute. I think they hiked rates enough that they can try to do policy on regular policy, not on the sort of, more off the book policy. So I think now they could easily cut rates, right? They don't, QE would again come last, So in theory, they hike 8 times, 9 times, 8 times, I think. So they can cut 8 times, or they can cut 4 times by cutting 50 basis points if needed. Before QE, don't forget the balance sheet is still of massive size. So for the Fed just to throw the QE word out, I mean, the panic it will create. Yes, I see where you're coming from when you say, if they start QE again, the risk is on. I actually have the opposite view. That if the Fed would mention QE anytime in the next 3 or 6 months, the world is just going to fall apart, and the doubts, the panic you create, because reality is they can cut 8 times, right, before they even mention QE. So QE, I think, is not the risk. What I still believe is QT to pause it probably makes sense, because QT, we have the tax cuts are running out this year. We obviously have hiked rates 8 times. That obviously, the impact is with a big time delay. So then you have at the same time a global slowdown that is a little bit more severe than was anticipated. So the Fed is suddenly faced with already a more, not restrictive policy in terms of financial conditions, but generally the higher rates had its damage on the housing market, with obviously mortgage rates going up quite a bit. We lose the stimulus from the tax cut. So the Fed is suddenly bombarded with tightening reasons from complete different, from the left and the right field somewhere. And for them to go on a pause, and that's why maybe I'm wrong, but I think the pause is really, okay, wait a minute. Let's just see how this is all going. And how the data is going to react to it, which is, we come to that in a minute. It's going to be a bit harder after the government shutdown to really assess the data. But So my core view is for next week, I definitely not going to sell risk too early. I do see, I fully agree with you that a pause in QT. Let's see if after what we've done on Friday, if that story gets some more legs or not. If it doesn't, I sell risk immediately. And let's just say for the record, if they would not pause QT on Wednesday, I hit Euro Yen and Aussie Yen wherever the price is, because we're going to come off rather rapidly, because I think the story has made its round in the market now, and it's kind of expected the Fed to do. So no, it's what else did I write down? Yeah, Australia, right? That's not going to go away. Europe is not going to go away. China problem is not going to go away. And whether QT nor a China trade deal will change any of the current slowdown we have in the world economy. And so therefore, my general view about risk hasn't changed. Technically, yes, it has changed. I'm not, I'm not ignorant to the fact, and that's what we both usually blog or talk about. If you know that risk can rally because of these reasons, there's no reason to sell risk. You just wait and see whether you get better levels. If you don't get better levels, if risk can't rally with this in mind, then the problem is even bigger than I thought. But I think that's my I think I said everything I wrote down.
Right. So, okay. That's brilliant.
So a last thing.
Yeah.
What I definitely agree with you is we will not know until, don't know, 3 months time, 6 months time, whether there is a Fed put or not. And you're absolutely right. If the equity market suddenly feels like there is one, even if there isn't one, then we're gonna rally some more. And you're absolutely right. The market is always right. So we have to just try to understand what the market is doing. And if that's the sudden view, then we have to respect that.
Brilliant. So I've got a bit of a back to, I'm going to bounce some stuff back to what you responded and what I said, is that, okay, so I don't think if the stock market crashes, because they're high, they're pretty high, right? I don't think if we have another 10%, the Fed will step in. That's not what I'm saying in the sense that in the sense of a Fed pop. So specifically, if data takes a turn for the worse, which we pretty much agree that it could very, very well do, then the Fed will step in or be pragmatic about it anyway. QE. I want to talk a bit about QE because if I do agree with you, the Fed's not going to mention the word QE at all. It doesn't mean they won't consider it. So there are a couple of things that Draghi did. He's the king of verbal intervention. He said, I'll do whatever it takes. And what the other thing he said was he will use all the instruments at his disposal, which is another way of saying unconventional, which is another way of saying QE.
Yeah.
So the wording will be very subtle, but I'm just saying don't rule it out. And the markets won't necessarily panic because it will just be, look, it will be an extension of him being pragmatic.
Yeah. The one thing I would say against that, Patrick, would just be that we can't compare Europe and the US from a cycle point of view. So basically what the ECB screwed up last year because of the single mandate, they never managed to hike when PMIs went through the roof. And now they have the problem that actually PMI is falling rather rapidly, while CPI is not a problem. So they never got their hikes in. So what the problem the ECB has, and that's why the underlying story to me is completely different, is the ECB never managed to hike rates. The ECB only just stopped QE, haven't really started the kind of, a normalization process. So the ECB has no other choice than, whether they bring the TLTRO in or whatever else they might be planning if the data continues to weaken. The Fed they have got some weapons back, which is 8 cuts if needed, right? So to me, that's why I really don't even want to think about the Fed thinking about unconventional measures at this point, versus the ECB might have no other choice. So I just think it's difficult to compare the two because they have a complete different starting point when it comes to, as you just rightly said, let's say the data starts to come off and suddenly the data in the US comes off a little bit quicker than the Fed would have thought. Yeah, maybe we do see a cut later in 2019, which we expected to be early 2020, right? So, okay, so the only time I would agree, but then we're going to make a lot of money with our short risk position first. If the Fed would have to go back on unconventional measures, the world has to, we can't be 9% from the all-time high in equities. We can't be, the way where the market is everywhere. There's actually, we had a bit of stock sell-off in December. Things got a little bit rocky compared to the 10 years of recovery. But if you compare what we've seen, even in December, or this kind of, general weakness we've seen, it's if the market starts to panic now, then we're in a serious problem because nothing happened, right? Nothing has happened other than, the Dow dropped 1,000 points in a day. That's maybe a bit uncomfortable, but it's not like things falling off the cliff. So that's why my belief probably is more on the pragmatic Fed, because you know what, you can't be ignorant, right? You have a job to do, and the Fed has a dual mandate, and they see growth collapses around the world. Guess what? He's not stupid, because sooner or later it's going to knock on the door of the US. Doesn't mean like a severe slowdown, but if the world slows down, guess what? The US is not immune when the world slows down, right?
Yeah.
And so all he's done is like just go, whoa, wait a minute, right? And that's why I'm so adamant about the view of watching data, which he basically told us already. You know me, I gone on about this for quite a few months. That's all he told us. The Fed was never dovish. The Fed was never, yes, they were less hawkish, but they never really were dovish. The market has gone, oh, they are hawkish. Oh, now they're dovish. No, they haven't. All he's done is he's removed a little bit of the hawkishness and says, you know what? The high date times, the data is flattening out, the world is slowing down. It would be stupid for me to just be on autopilot. Actually, that's the word he used for QT, which upset stocks a little bit at the end of last year. And now he removes the autopilot, right? So he goes, okay, no, sorry, we're not on autopilot. Certain things have changed, right? The way we change our view, he changed his view, right? And obviously, Fed George, the biggest hawk on the planet, that now suddenly is on the dovish, she's now suddenly in the dovish camp. She's gone for a pause because, all the incoming data around the world just points to a slowdown. And for the Fed to be on autopilot for just put another 3 hikes in 2019 would just be absolutely insane. So I think it's actually good. For once, I have to say it's actually good central banking, which I don't often say, but it looks actually not too bad.
Not that I want to have the final word, because I'll always leave you with a final word, because your words are much wiser than mine. But I will say, muscle memory from 2008 may still exist. Just saying. And in relative terms, you could argue, and I subscribe to this, pausing QT could be QE in stealth mode.
But that's definitely a form of interpretation, right? And the market will always pick what he wants to pick. It's a bit like, remember when we discussed last week, there was this fake news about Trump having said he's going to lower China tariffs, which actually in the same sentence next was denied by the White House. The stock market rallied. They only rallied on the tariff story. They completely ignored the denial. So sometimes you're right. Sometimes the market just tries to hang on to the story they want to believe, right? But that does not change macro. It changes maybe the short term, but it cannot change if something is fundamentally wrong. And I think if I had to have a scale, where I put like all the negatives in and I put all these short-term or these positives in, to me, the negatives are solid medium-term and the positives are short-term relief rally. To me, what we see is a short-term relief where we might have gone a bit too far too quick. Some stories changing a little bit. But one thing we should not forget, and that's why the rally you will see will never be the rally you would expect, is if the Fed pauses on QT, they don't do it because they're bullish, right? So let's not, there's a wrong and a right in different cycles of the story we're at. So we just come from a complete bullishness and hiking and whatever to normalize the balance sheet and blah blah blah, and we suddenly gone from 3 hikes to maybe none. We talking about a pause in QT. This is bearish news. Let's face it. And if the market, and don't hold me to that, the Dow may rally 1,000, 2,000 points, and I'm not selling it today. I'm not selling it tomorrow. But one thing I'm absolutely certain is this is bearish news, which will eventually come in bearish the moment this fancy short-term relief rally is over. So to me, pausing QT, I actually, after the initial rally, I put it on the negative scale. And that's why I'm absolutely, utterly bearish risk.
Yeah.
Right.
Yeah, that all sounds good. I guess I'm just going through the charts here, Beat. I guess my only thing is you're right, but sometimes it doesn't pay to be right in the sense that the market may take this higher, causing a lot more pain. So my next question, which I think I mentioned on the feed, is where do we start layering in some sell orders on risk pairs? So let's just go through the quick on the charts. Here's euro dollar. I mean, I quite like. I mean, this is a weakness on the dollar, obviously story, not the risk pairs. But I know the euro yen should, if that's getting lifted, it will help core. But the euro dollar daily, right? So I'd be looking to cover at 115 for now, 115.30. Really sticky anyway. I mean, tough to trade at the best of times. What do you reckon?
No, I agree. To be honest, there's especially after last week, I think a few people, what we already saw after ECB sold some low ones in the euro, which got squeezed already an hour later. So the market probably got a bit bearish last week on this double whammy ECB downside risk versus German GDP, lowering GDP. So now it's having this sort of pause QT, bit of dollar negative, chance for risk rally as he indicated with euro yen. Now suddenly we can break 115, take all the people out from last week, and maybe 15 figure 50 is probably a sell again. But it's euro dollar is so boring, I just can't get my head around it. So I might not even, when it gets to 115, maybe I sell some, but I have no interest in the next 2 days, 3 days in euro dollar personally.
Okay. And dollar yen, this has been a funny one. I tweeted the other day. I blogged on LinkedIn the other day saying that quite a few of the yen pairs were lower. Dollar yen, it doesn't look weak, So there is a bit of it's a bit of an odd one for me. What's your take on dollar yen, mate?
To be honest, what we've seen in the flash crash, obviously a lot of these fancy options got knocked out that some of the Japanese exporters have. So I think any rally in dollar yen is getting sold right now out of Japan, from rehedging, or whatever. I have no clue what the size was on these sort of clever put options with the 105 barrier or knockout they had. But the reason dollar yen is so slow, I think there's really hedging need coming in. Any rally to 110 at the moment just seems to be sold. I would think we can probably stretch to 111 at some point if this whole risk on gets a few legs, but I might still sell tiny on a early 110 just not to miss it. I think dollar yen looks awful. And going back to my point, what I wrote in December is the only dollar short I really like is dollar yen, because you either get the dollar side of it or you get the risk off side of it. Right now, it means actually it does not move, right? But dollar yen, I only be short. And whether we make the 111 or not, I'm not sure. I probably already sell on a lower 110 because there's no momentum in it. And if this QT story continues to maybe push euro a bit higher, the dollar a bit lower, there's just another reason why it will not rally, even with risk. Yeah, it may not collapse because of risk on, but I don't think it can rally much. But it's so static, and that is actually what I hated most of 2019 so far, and why I haven't traded a lot of short term is the days, the ranges are so tight. Even euro yen is back to its tight range.
Yeah. It's because of dollar yen, wasn't it?
Yeah, it's just awful. So it doesn't allow me to get a feel for it, because it's so slow, it's static. So we can argue, it's offer because it doesn't really rally. At the same time, if you get a really good risk on story, it suddenly overshoots. So you just can't trade it right now. And that really drives me mental right now because, the moment you try to do something, the story changes. Then you look at it, then it didn't rally as much as you thought. Then you still have to sell it. So it's kind of very PC complicated. And gun to my head, I'm always short dollar in any rally. It's
I mean that all makes sense. If I put my technical head on, this looks bullish to me. And we regained all of the flash crash because there was the break there, bang. We stayed above. I've got a little level at 108.15, which is on the daily. That failed there. Obviously, bit of a bounce there. It tried to close below that, couldn't, got rejected. I think the low there was 107.80, so it was 20 ticks below. Then it found a bit of a footing there, and then it started to grind up. We did cover a little bit of ground up there, 110.10. Bit of a tiny bit of a level there, and obviously we're consolidating at the highs. We're not. I mean, that's 1, 2, 3, 4. It's a few days there, nearly a week, nearly a trading week. Not really looking bearish to me technically. I like 111. I really like 112 only because of this blue line, which is the 100-day moving average. Up there, I really fancy it, but. So, I mean, you would want to be selling this, and it's the easiest dollar to sell. But the price is sort of, it's not really falling into place like it should for me.
And like I said, the price action, you can't take a lot from it, and that's why it's just random. It seems to be 109.60 every day. It's like euro yen was 124.60 every day. So, if I see the same rate more or less every day, and the only thing I might quickly add, why I probably agree with you that it can pop higher, is last week we had one night where the Dow sold off to minus 350. Euro yen moved down 10 points. The next day or the day after, the Dow was like plus 270, went straight line down to 100. So we dropped 370 points in like 2 hours. Euro yen moved another 10, 15 points. So we had two, and this is stuff again that I note when I watch. So we had two quite severe attacks on the downside in the Dow, risk effects in 1 hour. So these are things I note. And so that's why I haven't sold any risk last week. That's why I'm not going to sell any risk early this week, because the price action doesn't actually add up right now.
Yeah. So there's not a tight correlation with yen and stock. Yeah. Okay, mate. Well, look, quickly, euro yen. We're up to a little bit of a couple of less 120, 125 per fig, 126 there, and then that's just we'll see what happens. Let's just see where price takes us. Certainly, if dollar yen goes up, which it's just, I don't know, it's looking a bit odd, but we'll see. That will probably help this along its way. Whereas Aussie dollar, again, we're up at some key levels here.
Yeah, the Aussie and the CAD were the ones that benefited most of the QT story, right?
Right.
Because you have the double whammy. You have the dollar down,
Yeah.
and the risk on. So Aussie had a dramatic turn. Just when I actually gave up hope that it will rally. So I'm very pleased with the move, because I actually something like I missed to sell Aussie. So I'm actually very
interesting. Interesting. If you want to fade the Aussie, obviously NAB had some restrictions on loans, on mortgages.
yeah. They actually hiked rates 16 basis points.
Yeah, right.
And
okay.
That's when Aussie was slammed after the unemployment.
Because unemployment was all right, wasn't it?
Yeah, it was all right. And what happened is NAB hikes mortgage rate 16 basis points.
Right.
I mean, blip higher. And then the market smashed Aussie to pieces, because the view has been that if the banks, because obviously the housing market is the big problem, if the banks hiking rates, that actually increases the odds that the RBA has to cut rates to compensate, right? So rather than let banks hike rates, cut rates, because the last thing the RBA now needs is banks, because they're hiking rates not because of a good economy or because of inflation, whatever. They hike rates, whatever, for their risk profile, whatever they're doing. So they hike for the wrong reasons. So the RBA is probably very concerned that that move continues to actually put more pressure on the housing market. So that's actually why the Aussie was sold, because not just that the view would be it's bad for the housing market, it actually opens a door that the RBA actually could. It's not in near term, they actually talk as late as December to cut rates, but it opens a door for the RBA to cut if the economy doesn't improve.
I actually have a follower called Brian. Thank you, Brian, for he posted something on my feed to basically exactly what you said, but I've forgotten it. But thank you, Brian, and thanks again, Beat, for that. That's really interesting. Cable, I don't really want to touch cable, but there's the chart anyway. I would not be selling cable for love or money. DUP and Brexit, sorry, DUP and Reece standing up to Theresa May. Everyone wants to be buying this, but there's some still pretty brutal moves. I know what your thoughts are on cable. They just very tricky, very tough.
To be honest, as you remember, like 2 weeks ago, I changed my view on sterling that the risk is probably higher. But you know, it's what I keep saying. This, if you trade your own money, it's fine. You can do whatever you want because you only have to answer to yourself. The moment you trade investors' money, you know, you can't keep on talking about being 50-50 and then get caught either way of sterling. So from a pure macro fundamental point of view, I have sympathy for the people that see that from 6 outcomes, 4 are bullish or somewhat bullish and 2 are very bearish, and the odds probably point more to the 4 more positive outcomes. So I have sympathy why people did buy sterling. From an investing point of view, you know, running after the herd, of course, if everything turns well and the people bought it at 129, they're about 3 big figures ahead of the curve, fine. But you know, 120 given if it's a no-deal Brexit. So I can't take that risk, because reality is politicians have really showed us that we can't trust them.
Exactly.
Views change quickly. Whether common sense wins or, you know, infighting wins, who knows? I actually even don't know what we're going to vote on the 29th. I actually I have to look it up. What actually, you know, I'm so sick and tired of the topic that I don't even know what we actually vote on the 29th. But on the 29th, it's not a big vote. So don't worry, I'll be up to speed Monday or Tuesday to actually know what we vote on Tuesday. Whether it's whether we take the. And there was someone on LinkedIn making a good point that, you know, of course we all are worried about the no-deal Brexit, but for a negotiation, you can't take it off the table. That much I understand what Theresa May tries to do. And
Yeah.
some that, it's like you go in a car dealership and tell the guy, I'm going to buy the car anyway. I mean, you can't really negotiate the price anymore if you tell
Yeah.
them to buy it anyway. So,
No, that was a brilliant analogy.
so if you remove the no deal Brexit threat, you have no cards left to play. I mean, you could as well just go like, forget this stuff. We stay in the euro, right? I mean, I don't know. I mean, I just hope the topic goes away one way or another, so we know what we're dealing with. We're not going to get surprised anymore by some silly tweets or whatever. And I just want some normality back because, like you said, and you know me as the sort of person with a lot of focus on crosses. Last week for one day and the week before for one day, the sterling crosses impacted every other currency.
That's right.
Yen for sterling yen, Swissy for sterling Swiss, Aussie sold off for sterling off. So you can't trade the Aussie or the CAD or the yen because it was all sterling crosses.
Yeah.
So it just makes things so that's why you say, we have so many narratives right now to look after that I think this is the first month that I've in many years where I've hardly traded. I've done a bit of Aussie Kiwi and a bit of Noki Stocky stuff that is far away from risk on off. It's far away from sterling, far away from the dollar, and that's what I might actually do on Monday as well. Look for some silly crosses that have no correlation to any of the topics out there.
Yeah.
Because the rest is just, what do we do now? Now we wait for Wednesday. Now we have to wait for the Fed.
Yeah.
Right? Monday, Tuesday is already gone, more or less, unless someone comes out to deny it. But now you can't deny it anymore because we are in the blackout period. So the Fed can't speak. So it won't be denied until Wednesday, right?
Yeah.
Maybe there's another Wall Street Journal coming if JP is using Greenspan trick by just leaking some of the stuff out. But I guess Wednesday we have to wait for Wednesday to know more. Maybe we get news from the trade talks. I'm not sure when exactly they start, but the Chinese delegation will be in the US next week. So I guess Monday is already eaten. You don't even need to bother on Monday. There's not going to be much happening. And then it's all about QT in China. And no one even talked about non-farm payrolls on Friday.
What's non-farm payrolls?
To be honest, there was this funny Kudlow story I quickly mentioned on that.
The leak.
The sort of how tremendous the data is going to be. So, so obviously everyone's going to expect some tremendous data. So maybe we get pausing QT, trade deal with China, sensational non-farm payroll, which then obviously puts pausing QT in question. But anyway, we suddenly have like everything is all right.
Yeah.
For a week.
I quite fancy selling the dollar at some point, even if it's a strong non-farm. Sell the fact. If it's weaker, I don't know.
Yeah. To be honest, I mean, I'm the last year and a half I've approached non-farm payrolls just only to trade it if it's an outlier, 300 plus or 50 or below 100.
Anything really
100 and 250 is really a non-event. So
that's brilliant. I think we're going to wrap that up, Beat.
Yeah.
Perfect. Really good session. Really good session. I want to finally, if you're retail and you follow us and you're having a tricky time trading, I want you to. I'm going to leave you a couple of stats. Okay, so this is from a thing I got in the FT about hedge funds closing and Paulson looking to go family. And I think he used to be in charge of about 30 yards. He's now got about 8 yards himself, and he's looking that way, and how difficult it is to be successful. So Eureka Hedge had a little stat, which is in the weekend of the FT. 11,000 hedge funds are in the world, and last year 550 closed. So these are very smart cookies. So don't go easy on yourself. If you're retail, just there are some very clever people out there. Some of these hedge funds employ ex-NASA scientists, right? So just go easy on yourself. It's just, you know, it's very tough. And, you know, we've all had shocker days, and, you know, we've all had tough times. In my first year of trading, I didn't make any money at all. That was when I started, really. But, you know, so just be easy on yourself. The final thing I want to mention is, Beat, you've got an amazing commentary, and I've been using it for a long time. It is amazing. So do you want to tell our viewers a little bit more about that?
Yeah, I think I'm gonna do another one that I did last week. So
Great.
I will still offer 1 week free trial for all that I'm doing, all the charts, the trading IDs, the research I write, for a full week free. Take a look, and charge for yourself, because we talk about it a lot. You know, lets people find out what it is probably the easier way than to talk about. So my email is beatnussbaumer@outlook.com. You can ping me as well on LinkedIn or Patrick, and I give you the 1 week free trial, and make you know, see for yourself what the product is and if it's helpful.
That's fantastic. Beat, would you be so kind as to put your email on your feed? I'll do it again, put up my, just to sort of for people to write that down. That would be fantastic. I mean, I don't know. That is an amazing deal, to have a week of your thoughts, your 2 cents, your charts, your levels, and all that stuff. So you know, it really is a gift horse. Do not look it in the mouth.
Yeah,
that's all I can say. So well done, and thank you. Thanks
very much.
It's been a brilliant session, and I won't be mentioning that QE word. Oh, no, seriously. Let's just watch that. We will have a. I'm sure next week will be brilliant as well.
Yeah, perfect.
Thanks again, Beat.
Thanks a lot for having me, Patrick. See you. Bye bye.